Okay, so I am with Diane Reyes, and we are going to be talking about the first-time buyers. We're going to be answering some of the questions. Diane's going to be also helping us understand DACA and how that relates to home purchase. And then she's going to share with us some of the grants that are available. Diane, thank you for being here, and thank you for sharing all this information that you have with people who are interested right now or who want more information on buying their first home.
Hi, good afternoon. Just following here, I will be covering first-time home buyers, and questions you might have, you can always email us. And we're going to be covering DACA as well, since we are now finally able to make IDA loans, which is the grant for DACA. We're going to cover the grant as well. Excited
Great.
to all this with you guys.
So great. So we're going to share a PowerPoint so that you can give us some information, and we'll be recording this so that we can share it with people who may not have been able to see the whole thing or hear the whole thing. You'll be able to have it here on the PowerPoint. So Diane, you're with First Centennial Mortgage, and I will let you go ahead and start.
Perfect. So we are going to cover, as you can see, the overview, the introduction, the understanding, the steps, and I'm just going to go down to the pre-approval and the home search. So we start with an application. We take the formal application to make sure that you qualify. And as you'll see, we're in the introduction, and we will make sure that you income is there, your credit is there, that your job history is there, and of course that the value of the home is there. Those are basically the 4 points that we have to cover in order to get you qualified. And then we do look at assets to make sure that the amount of money needed for this transaction is enough to cover it. And if you don't have enough, that is where we come in and try to get the grants that are available to help you with your down payments. If you're working with the right team of real estate and mortgage professionals, makes us all a difference. Where Centennial Mortgage commits to working seamlessly with you and your real estate agent as a team to get your loan closed in a timely and professional manner. The advantages of owning and renting. So the first one is tax deductions. A good one to speak with your tax accountant. Your home is an investment. The values will go up and you will earn equity for your next purchase or when you sell your property. So renting, you'll never recover that. Buying, you will. And you start building equity on your property, and eventually that could become a rental for you as you buy up and you start now building more, not just the equity, but you start building more, oh my gosh, what am I looking for? Value. Pay your mortgage versus your landlord's. Rents are high because of high demand. In this market, mortgage payments are typically cheaper than rent. So a lot of times I hear people renting and paying for a 3-bedroom, 2-bath, and they're paying $2,000. Right now with the low interest rates, your payments are probably not going to be, but maybe $1,400. It just all depends. So it'll most likely be less than what you're paying in rent.
Got it.
Overcoming obstacles to home buying. What is holding you back? Is it your credit? Is it money? Is it job history? Is it residency status? Is it fear of commitment or responsibility? Is it bankruptcy? Is it foreclosure or short sale? We can work around a lot of these issues, and most of the time you might think that it could be an issue, and it's not an issue. That's why we need to take the application and discuss your situation and get you there. Who plays a role in the home buying process? You, the realtor, the real estate agent, the listing agent who is hired by the seller. This agent places a property in a multiple listing service, which is the MLS. database of properties listed for sale. Buyer's agent is hired by the buyer. So the listing agent is, and the sellers are who pay the fees needed in the sale. You do not pay your realtor on a purchase. It's the sellers who pay the listing agent, and then that's how it covers both agents. The mortgage banker, that would be us, helps you start and finish the loan process. First Centennial Mortgage is a mortgage banker, and we are direct lenders. What that means is we have inside and internal underwriting. Everything is internal until you close. Understanding your credit. What does your credit score mean? We can work with scores of 580 and above. Now, that is in normal times. 580 and above would be what would be an FHA loan, and that would be during normal times. Right now with COVID, the investors are looking for 620 and above. They have toughened up to where a 620 sometimes is even still not doable. It's got to be, there's got to be circumstances that we can maybe overwrite the conditions out there, but not everybody will. The preferred score to get a mortgage with less questions and less of a hassle is at least a 640. If we go back to normal times, yes, 580 is workable, but not right now. We are looking for a minimum of 620. In general, when we're talking about your credit score, they're referring to your FICO scores. There's 3 credit bureaus. We have Equifax, we have Experian, and we have TransUnion. And the middle of the 3, meaning we have a high score, the low score, and then we have the middle score. We try to go with that middle score. And that's the one that's going to count. And as you can see on this graph, you can see, I've seen scores lower than 579. I mean, I've seen scores in the 400s, so they don't start at 579. They do start in the 400s. And I have seen scores at about 860 is probably the highest I've ever seen. And that's very good credit. Not everybody builds that kind of credit. It takes many years of building and getting there. The credit score breakdown, the payment history covers 35% of your credit score. So the payment history, if you've never defaulted, that carries 35% of the weight. The amount owed carries 30% of the weight. Length of credit history is 15%. So the older the credit is, it carries 15% of the weight. The inquiries is 10%. So if you're out shopping for a car loan, that 10% will be bringing down your scores. Type of credit used. Revolving, which is credit card debt, is what carries the most. And that's where you see the most improvement is in credit cards. How to improve and maintain your credit score. Pay bills on time. Keep credit card balances low or pay the balance off monthly. Avoid closing credit cards that are not in use. Avoid derogatory items such as collections, bankruptcy, judgment, foreclosure, tax liens. Now, because you have any of these items on credit does not necessarily mean you don't qualify. That absolutely is not true. Bankruptcy, you are eligible after 2 years, but if there is a foreclosure that occurred in or around the bankruptcy and the foreclosure occurred possibly after the bankruptcy, we are tied to the last, the last of which occurred first. So if the bankruptcy occurred first, it's 2 years, but if the foreclosure occurred, say 6 months after, that's when they took possession of the property, then we're tied to 3 years after that foreclosure. Judgments are also, it depends on the amount. If we are looking at a judgment or a tax lien, the most possible that's going to happen, the most probable is going to be that we're going to have to get those paid off or settled. We cannot absolutely have tax liens open unless you have come to an agreement where you have been making payments already and you can demonstrate that you have made the past 3 payments on time and that you're going to continue making those payments. Collections. If they're medical collections, don't worry about them. We don't even ask that those be paid off. If there are other collections, most likely we will not ask you to pay them off. We might take them into consideration though as a payment, but not that you're going to have to pay them off. Sometimes when you pay off collections during the mortgage process, it's going to bring down your credit score. So we don't want you to pay them off. That's where you start talking to us, the lender, to make sure you don't go bring down your scores rather than help you, you're going to bring it down.
Okay.
Step 1, the loan pre-qual. It helps you determine how much you can afford to spend on a home based on 3 factors: your credit, including your credit score, credit report, and total debt history. We are looking at how much open credit you have and how many payments you have versus your income. That is a huge one. It's your debt to income ratio. Your income, including your employment history and income. Your assets, including money for down payment and closing costs. We do take all that into consideration. It's a big picture. How can we help you determine how much house you qualify for? Increase your bargaining power when negotiating with a seller. Estimate your monthly payments and total investment. Identify which loan product will fulfill your needs. That's all part of your pre-qual. So we have to see the full picture in order to let you know how much you're going to qualify for. Are you comfortable with that payment? Are you not? Sometimes you'll qualify for a sizable payment. That does not mean that you want that size of a payment. You've got to be careful with that. You do not want to be house strapped. You want to be able to live. So something to consider, and we'll cover all that when we take your application. Tips for a simple loan approval. What to do. Call us if you have questions. Don't feel bad. We are here to answer your questions, and you're not the only one asking questions. Everybody's asking questions, and that's what we're supposed to be here for. So don't feel bad and don't hold back. I'd rather you be informed than not be informed and not know. Continue living at your current residence. Continue paying your mortgage or rent on time. We do not want any bad credit popping up. Continue to use your credit as normal. Keep working at your current employer. Do not switch jobs. If you have to switch jobs because you just got a better paying job, maybe it's the same line of credit, but they're offering you $2-3 more an hour. I'm not going to hold you back from it, but I do need to know. We need the offer letter, but it's obviously a good change for you, so it'll help you in the end, and it'll help you with the mortgage process. Keep your same insurance company, at least until we discuss everything, and stay current on all existing accounts. Don't make any major purchases. Do not go out and buy a car. Change bank accounts or make cash deposits into your bank accounts. Do not deposit cash because we cannot use those funds. Transfer balances from one account to another. Do not be putting all money in one account thinking you've got to combine all accounts and all funds in one account. No, I'd rather you disclose all accounts rather than move accounts because it'll create more work for you and us. Do not close any credit card accounts. It hurts your scores. Do not consolidate your debts into 1 or 2 credit cards either. It'll bring down your scores. And most of the time when you go to these consolidation companies, what they do is they destroy your credit because everything falls behind, and then they try to combine, they collect the payment, then they negotiate with the lenders, and what they end up doing is they pay them only a portion of it without interest, but by then all your accounts have defaulted. So that means you destroy your credit. Avoid doing that. Apply for new credit or take out a new loan or co-sign a loan. Do not co-sign, because even if you went out and signed for someone else and they're making the payments on it, you're going to have to demonstrate that they've made those payments for 12 months before you're eligible. So you've just ruined your chances of qualifying at this point. Max out or overcharge on your credit cards. You never max out your credit cards. If you have a limit of $1,000, do not see that credit card as a $1,000 limit. You see that as a $10 limit per month. Do not even if you pay it off that night, do not use your credit cards, not when you're trying to get a mortgage. Then comes your step 2, which is your home search. Your real estate agent at this point will help you assess your needs and wants for your purchase of your new home. Know your preferences when selecting which homes to show and look up all properties in your selected area through the MLS. They will guide you and they will help you with this. They will negotiate for you. After selecting a home you want to buy, your agent writes up an offer to present to the seller. Then they come to a right price for your purchase. Your agent should know that the market thoroughly to help you get the best price on the home you want to buy. So they're going to help you. If they see a home that's overpriced, they're going to tell you this is a little too high. You might want to maybe offer this much. So they'll guide you on this. This is when you've got to trust them to help you. They help you avoid pitfalls and resolve problems. And they do respect your opinions and decisions, and they do protect your rights. That is the whole point of this. When you try to do this on your own, believe me, I've done plenty of these, and the borrowers are lost. They don't know what they're getting themselves into. Another big one I do see quite a bit is when you try to negotiate with these sellers on your own, you've got to have representation on your end, because if they have a listing agent, they're protecting their seller, and they're trying to make the most out of that sale, and they're not going to take into consideration what you are paying on this. They're really paying attention to their seller. So you've got to be represented by your buyer's agent. That's representing you. The other is a good one that I see and have seen over the years is for sale by owners. Got to be careful with those two, because they do not know how to prepare contracts, and they always think that their homes are worth a lot more than they are. When the appraisal comes in, it's not worth what they're saying. So you do have to be careful, and that's what a real estate agent will tell you. This house is way overpriced, or you're good. Formal loan application and product selection. Step 3. To complete an application and provide documentation, all pay stubs for the past 30 days. I typically ask for the last 4 pay stubs because it's a little confusing. Sometimes they'll tell you 30 days, but I'm paid every 2 weeks. But sometimes the month is over two pay stubs. In other words, it could be 2.5 months. I mean, it's not an exact month. I always go with the last 4. Your copies of your W-2s for the past 2 years and your tax returns for the past 2 years are always going to be required. When we are in a down payment assistance program, we ask for the 3rd year. So for normal loans, past 2 years. For grant, past 3 years. We always need your residence. Where have you lived in the past 2 years? We will be looking at your credit report, and we'll be looking at all your outstanding loans and credit cards, and all that will be taken into consideration. Your last 2 bank statements will be needed. That's just to start. And it doesn't mean that you have to have the funds in there. If you're going to need to gather the funds, or if you're going to receive a gift from a family member, we just need to know how much you're going to need. And we're going to let you know pretty much how much is going to be needed, so that it'll prepare you, or you can be prepared with how much you're going to need to obtain from your gift. Information about your real estate and personal property. We will be looking at, if you own any property, we will be looking for information on those properties, not because they're tied to this loan you are buying. That's a question I keep getting asked, but why are you asking if I'm not including this property? No, you're not. We have to document the property. Depending on your circumstances, we will need more information on self-employment, corporation owner, or VA eligibility. We do VA loans for those that are eligible for their loans. Those are great products because those are 100% finance. Those are like really good deal, low interest rates. And skip.
Oh, okay.
Illinois down payment assistance. Here we go. This is the down payment assistance. This is a good product that just entered. Now, these products, they've been available, but funds run out of one, then they open up a new one. And it could vary between 4,000, could be 5,000, could be 6,000, could be 7,500. Right now, the one that's going until the funds finish is the opening doors. It is available to anyone in Illinois as long as you qualify under their guidelines. So what it is it's a loan that is tied to your property as a second loan, but it's forgivable in this case in 5 years. So you never make payments, you don't pay interest on it. After 5 years, as long as you don't sell or refinance your home, that loan will drop off. So it's forgiven at 5 years, and then it just goes away. You never paid on it, but you have to have it for 5 years. The assistance right now is a flat $6,000. So if you're buying $100,000 or you're buying $300,000, it's still $6,000. So it's not a percentage. It is a flat $6,000. Now, if you were to have to sell your house, you're moving out of the country, you're moving out of the state, they will prorate the $6,000 in the 5 years. So if you sell in the second, the third, or fourth, you will be prorated. And then you're going to have to pay back a portion. You will never pay back the $6,000. So it's good money because, however, the interest rates, I'll pre-warn you, the interest rates are a little higher. Could be 1/4% higher, could be 1/8 point higher. Something to price out, because sometimes it makes sense to absolutely take the product because it's the same interest rate. So it's something to price out. First time and non-first time home buyers are allowed. As I said, anyone that lives in the state of Illinois. As long as they qualify, they will be looking at your income. That's a big one. And your debt ratios. We discussed debt ratios, income versus debts. Property must be a qualified single family dwelling. It includes condos, townhomes, and 2 units, not 3 or 4 units. So multi-units, the max is 2 units. The property has to be a home-owned property. It must be owner-occupied in order to qualify for this product. You cannot get this loan if you're buying an investment property. You cannot get this product if you are getting a house for your second home. And you cannot get this product if you're buying this house for your sister. It has to be owner-occupied. You will have to take a counseling, a homeownership counseling, and it is free. It's still free. They just recently changed it. It's more of it's an easy one. It's you have to take it online, and it's really it makes sense kind of counseling. And then you're going to be tested. I just had a borrower who said he failed it twice. I guess it doesn't always happen, so I don't want to scare you. You do have to pass it though, but it's like a common sense. So just kind of go through it. You must contribute. It does require that you contribute at least $1,000 or 1% of the purchase price, whichever is greater. So 1%, say you're buying a house for $90,000, 1% would be 900. They're going to go with 1,000. That very bare minimum, you do have to put some investment into the property, and that would be $1,000. Sometimes you end up putting a little more, but it's a great help. So I just need to let you know it's not 100% financing. It will not bring you to 100% financing because you do have to invest into the transaction. Your credit scores have to be at a very bare minimum, 640. That 640 is coming back. I'm mentioning it again because it's important for many reasons. And this is another one. You have to have a 640. Anything below that, 639 will not qualify. Your home inspection and appraisal, step 4. So what is optional and what is required? We, the lender, do not require a home inspection. We require an appraisal. That is what's going to give us value on that property to make sure you are not paying or overpaying for that property and the property is not worth it. They also do kind of like a minor inspection. Things have to be, the house has to be habitable and things must be functioning. Your heater in Illinois, it's cold, so we have to have a heater. We do not have to have air conditioning. In Illinois, doesn't get too hot. I mean, even though we do have a couple of months there that could get extremely hot, but it's not required in Illinois. Tripping hazards, they look for items like tripping hazards, electrical issues. We must have warm water coming out, so water heater must be functioning. You cannot have like broken windows, exterior windows. If there's a probability of you getting cut with a window because it's broken, that's going to have to be replaced. I mean, it's just broken tile, if it's a tripping hazard, if the stairs going up do not have the handrails, all of that are problems that could create us problems with the appraisal. So the house must be habitable and must be decent condition. The inspection is a buyer's option. They are more detailed on what is needed in that house. They might find mold where you didn't even think of looking, like the attic. So there is, that one is not required, but it is recommended. It's highly recommended by the agents. Get it, because if they find an issue, that an underlying problem, most likely they're going to find it. It evaluates the condition of the property while the appraisal determines the, and you see, because it's kind of blocking me here, the fair market value of the home. How and when ordered. It's ordered by the buyer. The inspection is ordered by the buyer. Did you change it? Did I go back?
Okay.
Oh, there we go. The appraisal is assigned by us, the lender, and we do not choose who gets to go. It'd be legal. It's a random selection, so they're rotating them, and whomever is next is who gets to go. We cannot select who gets to go. That way we make sure, they make sure that we're not trying to pull something tricky here and trying to give a value that doesn't exist. When is a report delivered? It's usually the inspection is given back to you within 24 hours after inspection. The appraisal can take 5 to 7 days after the inspection is complete. So they order, it could take 3-4 days to go to complete the inspection, but then from there we still have to wait another 2-3 days to receive the report. And as soon as we receive the report, you are notified, and so is the buyer's agent. They will make sure that there's no issues with the appraisal. And so will the attorneys. You've got to know also that there's no issues with the appraisal. Mm-hmm. Step 5 is the underwriter's review. So now we've taken the application. Now you've signed your disclosures to start up your loan. Now we've ordered the appraisal. Now file goes to underwriting. The underwriter will determine your ability to repay the loan. They will verify employment, analyze your total income. Your estimated monthly mortgage payment will be compared to your monthly income and debt. They will make sure that you qualify and that you're able to pay this home. They will also determine your willingness to repay the loan. How have you paid previous loans, your rent, your utility bills, etc.? What's on your credit report, in other words, and how the property will be used. Your credit report will tell us a lot. We pick up a lot from the credit report. So that's why it's important and pertinent that you take care of your credit. The collateral is the property, its marketability and condition. The underwriter takes a look at this appraisal and we'll see if there's any issues with the house. And that's exactly what we just covered. Step 6 is your final loan approval. That's what we call the clear to close. Congratulations. You have a clear to close. That means we're scheduling your closing, and once your loan is approved, you will be prepared for your closing. That's when we go to closing is your step 7. When your loan is approved, closing documents are prepared and they're sent to the title company. You will usually go to the title's office to sign the prepared documents. This signing is called the loan closing. That's when you sign. Prior to the appointment, you will be notified by the title company and loan officer of the amount of funds you will need to bring to the closing. You will be prepared with an amount to take either in a cashier's check. In some instances, when it's over $50,000, you've got to wire the funds to the title company. Going back to this, I just wanted to mention here quickly, the entire process, you start the loan, when I say you sign your initial disclosure, that does not tie you to the loan. You're working through the whole process, you're providing documents, it still does not tie you to the loan. It's this, when you get to the title company, when you sign this, this is when it's final. And once you sign and complete, there's no backing out at that point. There's no more issues that you really can find once you sign. That's it. The house is yours. The keys are handed over to you. Now we can go. What does a settlement agent do? They conduct the title search and provide a title report. We get all this during the process. They request title insurance policy. They adjust the taxes between the seller and the buyer. They make sure you're getting all the credits that you are to receive. In Illinois, we pay taxes 1 year behind. It provides they provide and prepare closing documents for the seller and buyer to sign. So we, the lender, send everything to them. They put everything in order and they get you there ready to sign and they prepare you. They make sure that the security documents are recorded and any other necessary documents are recorded with the county, so that they make sure that the county takes everything and they record in your name now. They distribute all signed documents to each party. So there's buyers and there's sellers and there's attorneys and there's realtors on both sides. They make sure that everybody gets their own documents. And they collect and disperse the loan proceeds, meaning they will make sure that the seller gets the money for what they're selling and receiving, and you come in, you're paying your portion. So they're basically working everything and balancing everything out at closing. What you will bring to the closing, you will bring one valid driver's license, current state ID, or your passport. Those are all valid IDs that you can take. Your identity will be verified because they are notarizing documents. So they need to make sure that it is you and that you have valid ID. A cashier's check or wire to the title for the funds needed will be needed, so that when you get to the title, your part of the money will be there. And we discussed that earlier too. 50,000 over requires wire. There's instances where some borrowers don't want to get a cashier's check and they're bringing 7,000 to the table and they choose to take a wire, which is perfectly fine, as long as the money is there. Any additional documentation requested. They might ask you to take a letter of explanation that they have the title company collect from you. We will prepare you and let you know if there's anything else needed at that point from you. Common closing costs that are needed, and some of these may not apply. So these are common costs when it comes to closing costs. Title insurance fees, which cover both buyer and seller title policies. They're common costs. When you originally see your fees, they look like a very high amount. They're adding all closing costs because they have to disclose all closing costs. Does not mean that you necessarily pay for all costs. You will start seeing credits back into them. In the end, you see that number going from up here to down here. So they have to disclose what's there, does not necessarily mean you are paying them. Miscellaneous title charges for title search, recording, and notary fees. It just depends on what's ordered by the seller's attorney. Your loan processing fee, that is a cost to us. That remains because that's the cost of doing the loan. The appraisal fee, that's a cost for ordering the appraisal that determines the value of the home. The credit report fee, we do not charge a credit report fee in our case. I do see that from a lot of lenders though. They charge a application fee, or they charge a credit report fee. I see all these fees. Ours is just a strict processing and appraisal, nothing else. But I do see it from other lenders. Some charge an underwriting fee for evaluating your entire loan package. I've seen that from other lenders. That does not apply, not with us. Administrative fee for processing your loan request does not apply with us. Prepaid interest, depending on the day of the month you close, that applies to everybody. That is, if you are closing, let's say you close on March 15th, your first payment is not going to be until May 1st. They will charge you the interest for those days. You don't make a payment, but you're going to pay the interest only for those days. Private insurance, which is your PMI or MIP in the FHA world, you will be paying if you do not give 20% down on conventional. On FHA, you will pay MIP, which is the same thing, for the life of the loan. In order to get rid of that, you have to either refinance out of that loan or just pay it off. You win the lottery and pay off your mortgage. That's when it stops charging you. The PMI on conventional, if you give 20% down, you will not have mortgage insurance. You also have an option of paying that mortgage insurance up front on conventional. And if you do the calculations, you have the option of paying that one time at the beginning of the loan, at the closing of the loan, and you're going to end up saving. The average that I've done is about $1,300. MI is paid 5 to 6 years. If you don't default, then it falls off automatically. If you default on the loan, they will never take away that MI. So you've got to make sure you keep those payments, make those payments on time. Otherwise, it will affect the removal of your MI. Now, if you were to choose it to pay a one lump sum, it saves you, rather than spreading it in the 5 to 6 years, average is about $1,300, which is not a bad idea. And you end up with a lower mortgage payment. The property taxes and homeowners insurance, those are taken into consideration. Those are your escrows. Your loan origination fee expressed as a percentage of the loan. So that is if you are buying the rate. That would be the only time I would say there'd be a loan origination fee. There really isn't, because we call those loan discount points. And that's to buy down, again, the rate. But I've seen that loan origination fee charged from vendors, and when I've questioned, they say it's to buy down the rate. So I don't know, I guess it's just how they disclose it. If you were to choose to buy down your rate, we would put it under loan discount for your rate. But all that, and I'd actually give you a copy of what I'm seeing so that you can see and choose what you wish to do. The components of your monthly mortgage payment. So your payment to your mortgage consists of your principal, which is your loan amount, the interest, which is the interest charged on the loan, your property taxes, your homeowner's insurance. You choose your insurance. We don't sell insurance. So you choose your home, who you wish to get your homeowner's insurance with, and the PMI if it applies. If you did 20% down, then you're not going to see that PMI. On conventional, if you're doing FHA, you're going to have it for the life of the loan. You move in, congratulations, that house is yours. They handed your keys. Your First Centennial Mortgage service to you doesn't stop. Your First Centennial Mortgage loan officer will be available to answer your questions during the life of the mortgage. And that is absolutely true. Have borrowers who have closed 7-8 years ago and they still call me with questions. I'd rather you do that than mess up, because there are a lot of information and email and mail that comes that are spam, or scams. You got to be careful with that. Given the ever-changing marketplace, it's a good idea to have an annual mortgage review. That would probably be a good idea, and that you get it from your mortgage lender who is carrying your mortgage at that time. They will send you an analysis, and kind of, if you don't understand them, call them, and they should be able to break that down for you. Yeah. Keep going. Okay.
There you go.
There we go. Yeah.
Okay, we lost you for a sec. That's okay. So
Okay,
go to the next slide, or?
so that's pretty much it. When you start the process, that's when we kind of guide you and prepare numbers for you and see what you're comfortable with and what you're not. You never want to get yourself, do not feel forced. That is a very important. Do not feel forced to do anything you don't want to do. You've got to be comfortable in this transaction.
Great. Well, thank you very much. Let me just bring this down. And I'll see you again. There you go.
Sounds good. Bye, everybody.
Well, I do have a question about the DACA program. Can you speak a little bit about the DACA?
Oh, okay. So on the DACA program is, we've got to show and document your work permit. It has to be valid. It cannot be expired. And the reason I say that, and I stress on that expiration, is because I received quite a bit of applications with expired DACA. If you have an expired work permit, you will not be eligible. It must not be expired. Now, the good thing is, it used to be we could do only split certain loans with DACA, and that was only conventional. Now we can do even the grant. So before they did not honor DACA, but now we can actually even do the grant with DACA because they're valid. They're filing their tax returns and you have valid Social Security. So we're able to now work with your DACA. No difference because you're a DACA. It is not going to affect your interest rate. It is not going to affect your program. If this is what you qualify for with DACA, it's the same as everybody else. No difference.
Wow. Okay, that's great. And you do that as well.
And I do DACA, quite a bit of DACA, yes.
That's great. Okay, so how can someone reach you? So their first step, if they decide that they want to get more information and buying a home, would be to contact you, or they could contact us and then we would refer them to you. You and Arturo, you and I have been working for a few years now together. And so they would contact you. How could they reach you?
So you can reach me at, I did not come in that. So my cell phone number, you can call me direct on my cell phone number, is 815-404-3434. My office number, which still comes to my cell phone, is 630-806-2843. Or email, it's d.reyes@F as in Frank, C as in Charlie, M as in Mary.com. Go First Centennial Mortgage.
Great. Well, thank you, Diane. Thanks for your help, and thank you for such a great presentation and information on first-time home buyers and DACA. And I think you mentioned one of the grants that was available, so thank you for that. And our phone number is on our screen. And if anyone has any questions, Arturo and I would be happy to help. And Diane is available to help with first-time home buyers, any questions. And remember, questions, the information is important. And we have that information. Diane has that information, so just give her a call or email her for any further questions. Thank you again. See you soon.
Have a good night.
Okay.